Hi, good morning and welcome to our program. Today we're going to be discussing the fourth series in the Associate's Guide program, Reducing Your Risk of an Estate Tax Audit. This program is a basic program. It's meant to give you a good, solid understanding on how to reduce your risk of an estate tax audit and the preparation and filing of an estate tax return. We're also going to be talking about ways to reduce the risk of audit during the estate planning phase. And then we're going to end on some practice pointers that if you do get selected for an audit, what you can do to try to get the best outcome for your client. This program is 90 minutes long, and if you do need to take a bathroom break or grab a snack, go ahead because I'm not going to know. Also, please feel free to ask questions because there will be someone here taking those questions down and popping them on the monitor, so I'll be able to answer them. And let me just tell you a little bit about myself. I've been doing trust and estates exclusively for more than 20 years. I know I don't want to look that way, but I have my own firm here in New York City, and I also teach law school as well. I've taught for 10 years at Fordham Law School doing their Wills and Trust course, and in this January I'm going to be teaching the estate planning clinic at Cornell Law School where I went. So welcome to the Associate's Guide Part 4, How to Reduce Your Risk of an Estate Tax Audit. So again, the three things we're going to talk about is one, we're going to go into some details on common errors that come up when you prepare an estate tax return, and in that preparation phase, how you can reduce that risk of audit. Second, during the estate planning phase, what can we do when the client comes to us and we know there could be storm clouds forming down the road? What can we do to minimize those risks? And then the last, again, if we are unfortunate to get chosen for an audit, and sometimes the estate that you have really it's almost a given you're going to be audited for the type, the size, the type of assets, how you can effectively work with the IRS to get the best possible outcome for your client. So when we're talking about the preparation of a estate tax return, the objective is to focus on what you as practitioners can get it right. And again, it's sometimes in the planning phase to reduce this risk of audit. Now, sometimes there are factors that you can't control. For example, the decedent had interest in closely held businesses or expensive art. Those are assets that are intrinsically hard to value. It's not like on a stock market exchange where you get the actual number of what the value is, or a bank account. What was the value of the bank account at the date of death? They are subjective in nature, those values, and will be appraised, which we're going to talk about a little bit later. But where you do know that you have a high chance of getting audit, there are still actions that can be taken to prepare in advance and to make the audit go as smooth as possible for the client. And most significantly is managing your client's expectations along the road. A lot of times clients get frustrated and upset, and a lot of it is because their expectations are here and reality is there. So having frequent and honest and straightforward conversations with the client to inform them about the process, what exactly is involved, I definitely think is helpful for everybody. Let me tell you a little about the background of this program and how it came to be. So the first part of it about specific common errors in the preparation of a estate tax return and how to reduce those risks. I got that information through multiple informal conversations with my contacts, and I would say, and friends with the IRS and the New York State Department of Taxation and Finance. My 20 plus years of preparing and filing estate tax returns, and also just being in the business and having conversations and consultations with seasoned colleagues. So if any of you have seen some of my programs before on the Associate's Guide in the Trust and Estates unit, I always say that my goal for each of one of you today is that all I want you to do is learn and know 3 new things. That's it. 3 new things, but in 6 months' time. So, and as I go along, I will highlight some of those 3 things, and hopefully you will remember them. Because, you know, a lot of us have been to fantastic programs, and we're there and we're writing notes, and it's interesting. And it's like, oh, these are really great. I'm going to learn this, and I'm going to use this in my practice. But then, you know, 2 weeks later, a month later, 6 months later, it's like, no, what are some of the things that I remember or learned in that program? So again, as we go through it, I'm going to highlight a few things. And also to help with that, I have some handouts as well. So let me just go through the ones that you should have, and they will be available now and afterwards. So the first thing I have here is the checklist on items before filing a 706. And this is pretty much a kind of like a summary of some of those highlights of our discussion that you can kind of use as a last-minute checklist. Give them to the associates, give them to the paralegals. So that way, before they file, you have this list, stick it on the bulletin board, and you can have that, and hopefully will reduce that risk of audit for the clients. The second thing I have here is a state administration checklist. These are the items for the client to bring on the initial meeting on the estate administration intake. So we want to make sure we gather all of the correct information, know exactly who is responsible, what is responsible. We'll go into that a little bit later. But this I've used very effectively before the client comes in, the new fiduciary. Let's make the most of our time. You know, time is money. We're lawyers. We bill for our time, right? So let us make the most of that time. Here's the list. Organize it and bring it to the meeting. There's no emergency generally. You know, whether the client comes in this week or next week, better to have all of the information so we can have a very productive first meeting. Okay. The third I have here is an article, Common Estate Tax Audit Triggers and How to Avoid Them. It's an oldie but a goodie. This is you know, some of the things we'll be talking about today are drawn on this article, and some of the information we'll go through is from my recent conversations and with my contacts at the service and colleagues. But a lot of these points are still good and true. It was from the Estate Planning magazine several years ago. Okay. The next item is here. This is a sample index to the attachments of an estate tax return. When we're preparing an estate tax return, as we talk about, there'll be certain things that you must submit, and there's certain things that you may wish to submit, again, to reduce your risk of audit. My personal approach is I want a robust return. I want to make sure every number on that return has backup, and that information is submitted. I believe it presents well. So if the IRS has any question on any where I got those numbers or how I got those numbers, it's right there for them. Hopefully they'll answer all of their questions and they won't bother me and my client, which means money saved. And clients love to have that money saved. So this here is a sample index of some of the things that are commonly found in the attachments to the estate tax return. And I sometimes joke with the clients early on. It's like, well, it could be like a small Manhattan phone book. The next item, estate checklist, important dates. Okay. This is very important in managing the process and managing the client's expectations. We all have to work together. As many of you may know, estate taxes are due within 9 months from date of death. We want to get a hard number so we know how much we have to pay. We don't want to have interest and penalties. So having these important dates will have us all on the same page. I tell them, this is for your refrigerator. You know when we have to file the return. You know when we'd like all of the information in, and that way we try to stay on track. Okay. And then the last document this is an outline summary of the program. This is in bullet point form, so you could either follow along here at home or later on in the tape. So those are our materials. Okay. So now let's just start with the first part of our program, reducing your risk of an estate tax audit. So let's be honest here. Getting selected for an audit is an expensive exercise and can delay the closing of the estate for months and even up to a few years. So one of my favorite sayings, and again, my approach to the preparation of an estate tax return is as wisely said by Benjamin Franklin, an ounce of prevention is worth a pound of cure. So again, let's do a robust return. Make sure we cross all our T's, dot all our I's, and be very careful and when we submit that return. So some of the items that commonly are common mistakes that could raise your risk of audit are careless. But they're common errors. And some recommendations that I would go over may be basic, obvious, or maybe even repetitive. But I feel that taking heed and putting that additional time is definitely value added for the client. So let's talk about the first audit issue, and that is a deficient appraisal. Now, the valuation of assets that do not have a readily available market value, again, such as real estate, interest in closely held businesses like limited liability companies, family limited partnerships, they may prove problematic and trigger an audit if the appraisal of the assets is not properly and carefully prepared. Okay. Again, as I mentioned earlier, this is due to these types of assets, the subjective nature in their value, and the potential to contain more, values that are more favorable for the taxpayer. So it is strongly recommended that you submit an appraisal that will withstand the closest scrutiny by the IRS. Okay, so that is one of my, please remember this from 6 months' time. Get a good appraisal. So let me just show you a couple samples here. A real estate appraisal looks like this. It is not a broker's letter. We'll talk about that a little bit later. It has a picture of your property, a description of your property. It has comparable sales to your property around date of death. Okay, and then it'll go into adjust the value of your property based on those comparables. Some might be better, some may be a little bit worse, a description of the neighborhood, but this is what it looks like. Okay. Now, the valuation of a closely held business. This is generally what it looks like. And it is a real significant document, and it is not an inexpensive exercise. Okay, so again, some of these tips we're going to talk about seem basic, but when you're getting an appraiser, for your appraisal, they should be a qualified appraiser. It should be a qualified appraisal by a qualified appraiser. So just recently, for example, a friend of mine who's a retired estate and gift tax attorney from the IRS with over 37 years of experience told me about this case where there was a large estate with closely held businesses submitted and they submitted the value of the decedent's interest in the business by updating the sales data from a few years prior to death to the present value of the company's financials instead of organizing an appraisal. So they just took the sales numbers, they updated what they thought would make sense, and that's what they submitted for the value. Now, a month later, the taxpayer filed the 706 with this valuation done by them, the taxpayer, and then a private equity firm came and gave a huge offer for a part of the business was substantially higher than the submitted value. Now, in this audit, not only will there be additional estate tax because it's a higher value, but now the IRS is going to be slapping them with a 40% gross undervaluation penalty. Pretty bad, pretty ugly. And the issue here, the issue with this penalty will turn on whether this offer by that private equity firm was foreseeable at the time of the valuation date. Now, the challenge is there's no expert to substantiate the submitted value. So, you have your business appraiser. They go and they do their due diligence. They talk about the company, the market, comparable company analysis, discounted cash flow. So if you had an appraisal and you'd have an expert to say, oh yeah, no, we took into consideration that there would be no offer out there, or this is what the market is. But now the taxpayer doesn't have that. So the lesson learned is if they had a solid appraisal, they could have protected themselves from that undervaluation penalty. Another point, common sense, Don't cheap out on the appraisal. Another estate tax attorney shared this piece of information to me. And she told me of that the use of a broker's letter to supply the value of the decedent's real estate. And I have to tell you, here and there, clients will say, oh, so-and-so in my family is a broker. They'll give me a letter. I don't need to spend, the $800 on an appraisal. I don't agree. The taxpayer is, is possibly facing an undervaluation penalty as well as an increased estate tax if you don't use an appraisal. And now the IRS in-house has top appraisals. So you're going to get a good product. The lesson here is that the cost of an error in judgment of not spending and getting a good appraisal could actually cost more than the appraisal itself. And even more so, if you think about it, the cost of an appraisal, that's an estate tax deduction, right? So the government is even, underwriting or paying for part of the appraisal. So definitely use it. Now, I have a little bit of a practice tip on this very point. So when the client comes in and we have real estate and we start talking about an appraisal, one thing I also talk about is, are you planning to sell the property? So if you're going to be having to sell the property to effect distribution of the estate to the beneficiaries, nobody is living there, you need the money from the real estate to pay taxes and expenses. So in that particular case, and you're going to be selling it, a very common suggestion that I make is don't spend the money on the appraisal, let's just sell it. And instead of having the appraisal, you'll attach the sale documents, okay? And I always like to put down on, in my estate tax return, when I'm attaching a copy of the sales documents, which is usually the closing statement and the contract of sales, that this property was sold through brokers to a disinterested third party. So that way there can be no question like, oh, you sold it to your child at a sweetheart deal. So we don't want that either. Another point here is that if the client is, well, I'm not really sure, but I may want to hold on to this real estate. We don't need it for the distribution of the assets right now. We're okay to hold it and maybe distribute it in kind to the beneficiaries. And so we think it's a great investment. So what I'll say then is that if you really want to do this, why don't you wait and sell the property after you receive your estate tax closing letter? And the reason why I say that is that you have your appraisal, you submit it, remember the appraisal as of date of death, or remember alternate valuation, which is 6 months after date of death, if that will result in a decrease in the estate taxes. And remember, like a little sidetrack and alternate valuation, you have to value the assets on date of death and alternate value, take which one is lowest. You can't kind of pick and choose. You can't say, well, I'll take the date of death value for this one and I'll take the alternate value for that one. So you can't do that without, and in the case of real estate, if you are going to be doing alternate valuation and you're not going to be selling the property, you're going to have two different appraisals, right? So, back to my point is if you think you're going to hold on to the property, the client said this is a great investment, we want to hold on to it for a while, wait until after the estate tax closing letters, because if you are selected for audit and here's your nice appraisal that says the property is $100,000 and then a year and a half later, it's sold for a lot more. We don't want to get in a situation saying, well, the appraisal isn't perfect science. We're going to use this actual sale price and we're going to discount it back to the date of death and here's your new number. It's like, you don't want that. So those are my two thoughts here. Now, another practice pointer is, say you're in the middle of an estate tax audit. And it's taking time, maybe because it's an audit and you have a lot of closely held business interests, and that's something that generally do raise your risk of audit and can take longer time. And if during the audit you feel that you're not going to receive an acceptable settlement for your client or having problems in the field, meeting with that estate tax attorney that is on the matter with, let's just pause for a second here. I want to make clear that, and this is a very common misconception for clients out there, or practitioners that haven't really worked in this field exclusively or with many years experience, is that the people that are going to be auditing you, they're not an auditor. They're not a clerk. They are an estate tax attorney. And many of these people have over 20 years experience, and they know a lot more about this than your average even trust and estate tax attorney. So call them an estate tax attorney and show the proper respect and understand the person that you're going to be working with is a very knowledge and experienced professional. So say you're having problems, in your estate tax audit, and you know that it does not look good, that you're going to have a settlement that's reasonable. Go to appeals early and at least 1 year before the statute of limitation runs. So in general, Internal Revenue Code 6501 sub A requires the IRS to assess an estate tax liability within 3 years after the filing date or due date, if later, of the estate tax return. Now, appeals cannot take a case that has less than 270 days left in the statute. Appeals will reduce penalties due to litigation hazards, and they are very proud of their high settlement rate, so I've heard. So they are trying to be reasonable and are trying to settle all cases. So again, if during an estate tax audit you feel things are not going to go your way, go to appeals early and try your chances there for a settlement that will be more favorable for your client. Okay. Next point in the appraisal. The practitioner should collaborate with the appraiser. Okay. It does not mean you get involved in their job to determine value. They are the experts. But you should carefully review the appraisal before it is finalized and submit it. Now, so what I say to my appraisers, let me see a draft of your appraisal. Because look, we're all human, right? We all make mistakes, especially, the most common mistake that I see is typos. I mean, think about it for yourself. How many times have you worked on a matter, wrote something up, and you put it down, and then you pick up that letter the next day, you read it again, and like, wow, what did I see here? I missed this comma, here's a missing word. So we're all, this is a very common oversight by all of us, so it is good to take a look at the draft. Okay, so now you have your draft appraisal. So let's now focus on some of the things that you should look at when you are assessing that appraisal. Okay, first, the introductory and the methodology statements match your particular situation. So, in other words, the appraisal does not read like a fortune cookie. Okay, it is very specific to your client's situation. In fact, one estate tax attorney told me a story where he was auditing several large estates, where coincidentally the fiduciaries used the same large appraisal company firm. And he joked about it. He said, hey, if you put all these appraisals next to each other, they all seem the same. And in fact, he further joked, said, hey, wouldn't it be interesting if we could have brought all these estates together into tax court and get them all thrown out because they seem like they're all discussing the same entity? Okay. So you want to make sure the appraisal is specific to your situation. Now, another estate tax attorney told me how she was reading the appraisal and it talked about a different property. And yet another one used an improper valuation date, not the date of death value of the alternate valuation. Again, these are simple things. You don't have to be, you don't need to be an appraisal expert. Look for those items and save your client time and money and add value to the process. Also, when you're taking a look at the appraisal, the discounts, which are inevitably in there, all discounts should be solidly supported as to why that specific discount is appropriate. So the service takes issue with an appraisal that has a wide range of discounts. They're given, but no explanation is explained why that particular number is in the range that was settled on. So again, if they give a range and they pick a number, you got to give the why. Why is this number? Because if you give the range, they're going to, the appraiser may say this is the low range. It's like, wait, the IRS is say if you have the high range, why not have the higher number? Okay. Another estate tax attorney commented on being careful about your appraiser inappropriately stacking discounts. Okay. Meaning having multiple discounts for the same issue where they're really the same issue, or one discount takes into consideration of the second. And the examples that were given to me, so there's a net asset discount of 6% to take into consideration broker's fees. Now, this is already factored into the marketability discount. So we don't want to see a marketability discount and a net asset discount, because the marketability discount takes in consideration those broker's fees. Or say having an investment company discount and a lack of control discount. The IRS feels that these two discounts are the same issue and are just being called different things. So take a look for that as well. Okay. Now, generally, when you're reading this appraisal, it should be straightforward, use recent studies, and overall make sense and reflect the business reality for your client. Okay. One estate tax attorney joked with me, said, oh, those closely held businesses, they never earn any money. And then she asked, hey, would the taxpayer sell the business for the value that they're submitting? So again, when you're looking at it, it needs to make sense. Okay. Now let's talk about the real estate appraisals, because those are the most common. Like, many of my states, have the family home, and it's either sold, and again, when I'm selling it, again, I just used my contract of sale in my closing statement, and a statement it's sold to a disinterested party, or we're going to have it appraised. Okay, so we have our appraisal, and some of the things I'm going to look at when I'm reviewing this, and I found mistakes there, and then I say, hey guys, made these small, we have to make some changes here, and it's usually very quick and prompt and no problem. So what I'm looking at is, one, the date of the appraisal is the correct date of death value or the alternate valuation date. Okay. Really simple. It's usually right in front. Here it says as of. Make sure that you have your death certificate, you have your appraisal, make sure the dates match. Or again, if you're using alternate valuation, make sure that date matches. Okay. The address of the property is correct. We want to make sure you got the right property. Take a look at those comparable sales in there, because you're going to see in here, typically they're going to have the subject property, they're going to have comparable sale 1, 2, and 3. Okay, take a look at those comparable sales. Make sure they have the sale date that's close to date of death, and if it's not, find out why. You're going to review the description of the neighborhood and how the properties compare to others. So in other words, if you know that your property was one of the ones, or the worst ones on the block, that they haven't renovated the bathroom in 40 years, or the kitchen, is a disaster, you want to make sure that is noted, okay, and that the appraiser did get that and say, hey, because if the ones on the block, most of them have been renovated or nicer, and yours, the grandma lived in it, since she was 30, and she died at 85, and that she never made a single improvement, you want to make sure the appraiser knew, hey, did you go, and make sure there should be pictures of the subject property inside the appraisal, but just make sure they know, this is a gut renovation we're talking about. Or if you happen to know that they did have it newly renovated, and it has the Sub-Zero refrigerator and the granite countertops and the glass tiles for the for the kitchen, and that amount is that it has been renovated. You want to make sure that makes sense also. Okay, and just kind of like a side note here, because the estate tax exemption has increased and is now indexed for inflation. A lot of folks now are in these these estates that are large but not very, very large. They're more thinking about income tax minimization. So in some ways, if you do have a renovated property and it is in the higher end of the block, having an appraisal that has a nice big value that's reflective of all of the niceties, if the family then turns around and sells it, they're going to minimize their capital gain exposure. So that's just kind of a thought in the back of the mind there. Okay, let's talk about a practice pointer on our business appraisal review. Okay, now I showed earlier, this is a very common business appraisal. It's not a small document. I just have a couple pages here in the front here, but some of the things I'm going to look here, again, I might have mentioned before, is that, again, the date of the appraisal is correct. The interest that the decedent died with is correctly described, and that description of the business is specific and proper. Okay. You also want to read, especially in a business appraisal, you want to really read it carefully for typographical errors and parts that may be confusing or hard to understand. So, one estate tax attorney told me, look, if this is selected on audit and you're going to be defending your appraisal, you need to understand it to explain it to the estate tax attorney. If you can't explain it because you don't understand it, how do you expect them to believe what you say? So, make sure you understand it. And if you're reading it and you're saying, I'm not really sure I'm getting why you're saying this, talk to them and say, hey, can you rephrase this? Help me understand what you're trying to say, and then have that conversation, and maybe some tweakings may be in order. Okay. The methodologies used for that valuation should make sense to you. Again, I'm not asking you to be the appraiser here, but put yourself in the shoes of the estate tax attorney and say, does this make sense to me? Review the stated assumptions and facts and confirm that they're correct. So, if you happen to know from the client a little bit about their business, which you should, and you're reading in the appraisal that it doesn't seem to be correct, so you need to make sure that everybody's on the same page here. Okay. Again, all discounts need to be substantiated. And then, kind of a lesson learned or a little bit of a practice tip, and especially when you're talking more about business appraisals, you generally get what you pay for, okay? Business appraisals are typically several thousands of dollars. If you don't have a good relationship with a business appraiser, ask around, okay? Speak to a few colleagues and interview a couple of them. Okay, now let's move on to audit issue number 2. Failure to include prior gift tax returns. Now, this is a common mistake, okay, that can cause an audit, because if it is required for you to include all of the decedent's gift tax returns, that's Form 709, with the estate tax return. Now, this is a requirement, and it's stated in the instructions to the 706. Okay. Now, copies of past 709s can be obtained by filing Form 4506, and if you do not know the years or uncertain, you can then ask for historical record of the decedent's gift tax returns from the service. So it's not uncommon for me getting a new estate in, and they're like, yeah, I'm not really sure, or I lost it. So, take this on early, okay? If you need to get those returns, I'd rather know sooner rather than later, because getting information from the government, it's not quick. So you want to make sure you're planned properly, okay? Also, you can add value when you take a look at those gift tax returns and review them. Now, you as a tax practitioner can determine if there is a risk of revaluation of past gifts for the failure for that past gift tax return to meet the adequate disclosure requirements. So, if you have a gift reported on the decedent's gift tax return and you fail to meet that adequate disclosure requirement, that means that statute of limitations have not been expired, and then the gift can be reassessed by the service during the estate tax audit, which means, accordingly, the ultimate estate tax liability can be increased. Now, if you look at those gift tax returns and there is a concern there, I would rather deal with that risk now when I have time than later when you're in the hot seat. So better be prepared to address the issues and have that time to get the information that you need if you feel that there could be a risk of not adequate disclosure for prior gift tax return. Okay, practice pointer here, okay? If the practitioner is also filing a gift tax return in the year of death, which is not uncommon, so you have a client that is working with a great estate tax attorney. They're on a gifting program. They're making regular gifts, and they're just made their regular gift as they normally have. One of the practice pointers here, if you're going to be filing that gift tax return and you're going to be filing that estate tax return, file them separately, okay? Do this in 2 separate envelopes, certified mail, return receipt requested, because a common mistake, which is no fault of yours, but doesn't matter because your client winds up paying the price through a potential audit or a problem, is that if you're filing that package together with the estate tax return and the gift tax return, the returns can get stuck together, and one may be processed and the other isn't, which will result on questions, increased legal fees, delay, and a client that's annoyed, even though technically it's the IRS's fault and not your fault. So 2 separate packages, please. Okay. Also, practice pointer here, it was noted that the adjusted taxable gifts number in the gift tax return is also a very common mistake. This can throw off the calculation for the gift tax payable. So review those past gift tax returns properly. Make sure on that 706 that adjusted taxable gift number is correct. Okay, let's now move on to audit issue number 3. Okay, incorrect tax allocation. Now, another common mistake that's picked up in audit is that the tax practitioner's failure to follow the tax allocation clause, in other words, the tax apportionment clause in the decedent's will or revocable trust. Now, as you may know, for those of you that do a lot of estate planning, sometimes the document will direct that estate taxes be charged to the marital deduction or the charitable share, now, which can cause an interrelated calculation, which then reduces the marital deduction or the charitable deduction, which then increases the estate tax due. Now, state law generally favors the taxpayer where that tax allocation clauses are ambiguous, but if that tax allocation clause is not ambiguous and clearly directs that the taxes be paid from the marital share or the charitable share, creating this interrelated calculation, which results in a greater estate tax, the service will make sure to enforce that language in the decedent's testamentary document, which again will result in an increase in estate taxes due. So take a look at that, please, folks. Now, let's move on to audit issue number 4. Errors in reporting jointly held property. Okay. Jointly held accounts are frequently not properly reported on the 706 and has become one notable area that is often the focal point of an estate tax audit. Now, the most common example still given today is where we have jointly held property listed on Schedule E1. Now, if I had a whole live audience here, I'd say, now what is Schedule E1? No, remember, Schedule E1 is qualified joint property, which means it's jointly held by a surviving spouse, okay? So they have property listed on Schedule E1, which means for the surviving spouse, and there is no surviving spouse. So make sure you put it on the proper schedule. It should be on E2, right? So we want to make sure that you don't do that one. Okay, another common example in our jointly held property is that you fail to complete the percentage includable column. Okay, so if you remember in your Schedule E2 here, you have your percentage includable column. Even if you're including 100%, say it's 100%. Okay. Also, say you're not including 100% because, say, the decedent and an adult child went in 50-50 and bought a summer house together. Okay. You need to attach an explanation why, as to why you're only including 50%. Okay. Or another issue here is convenience accounts with the decedent and a non-spouse. Okay. Now, here it can be challenging to have the proper exclusion of these accounts. The onus is on you, the taxpayer. So if it was a convenience account, you need to prove that it was. Meaning, like, say you had the decedent and a friend, and because maybe there was no adult children or no close family relatives, and the decedent had the friend on the name as a convenience account to help pay the bills, maybe they didn't have a power of attorney or they just did this. And it was really the friend's money. It's not the decedent's money. The friend put the decedent's name on it. You have to then, attach an explanation. Look, the decedent's name was on it, but their very good friend put their name on it because they wanted it as a convenience account, okay? Now, here's a planning point here, folks, and we'll talk a little bit about this in depth later, that in the estate planning phase, have that conversation with your client to identify and discuss any of these convenience or jointly held accounts where some of it belongs to not the decedent or the client. And let's document the contributions and what the story is now. Have it done now instead of after the fact. If you have it done in the planning phase and when the client is no longer around, you can attach that memoranda or attach that explanation so it's not looked as self-serving. Okay, let's move on to audit issue number 5, okay? The exclusion or undervaluation of personal property, okay? So here, returns that are deficient in the proper reporting of tangible personal property, that's the miscellaneous property schedule, Schedule F on Form 706. Here where they're likely selected for audit. Now, the two common areas that my colleagues brought to my attention, I've seen, is to complete. You have an omission of an item that should be listed on the tax return, or an obvious undervaluation of an asset. So let me give you some examples. So like a clear omission that you should have had, or an obvious undervaluation. So here's some examples. So one estate tax attorney gave me an example of, like, here we had a decedent who was a very wealthy woman, and she died with no engagement ring or no wedding ring. And the estate tax attorney thought, like, wait a second, here's this decedent who was a very, very wealthy woman with no engagement ring, no wedding ring. What happened to it? She must have had one. Did she give it away? If she gave it away and she comes from, and she has a lifestyle that would say it would be a very large ring or very expensive ring, was there a gift tax return that was filed or not filed? What happened to it? Okay. Another example, okay. Say your decedent lives in the suburbs and the person dies without a car, okay. How did the decedent get around? So here's an obvious omission. Or say, another example was, here we have a decedent that was into horse racing and collected horses, did a lot of races. So what happened to the trophy collection? Now, a good example for undervaluation is, like, here you have this decedent, say they have an estate of $15 million, they lived in a big, beautiful house, and then for the tangible personal property, meaning the contents, you only have $2,000. I mean, come on, it has to make sense. I mean, I remember one story being told to me of a colleague that they had an estate of a very famous person, and the estate was in the millions and millions of dollars, but the person, definitely lived modestly and, did not invest a lot of money in their furniture, like they were an IKEA shopper or a yard sale shopper. In that case, I heard that the estate tax attorney actually went in and took a look to make sure that they truly were, living way below their means, and they did. But, it just gives you an example. And if you can kind of think about it, if you were an estate tax attorney, wouldn't you think that? And here you are having a very large estate, and so you're expecting, if you live in a big fancy neighborhood with a big fancy car to impress all the neighbors, shouldn't you? And you're having dinner parties and people over for Thanksgiving or Christmas or Hanukkah, wouldn't you gonna have appropriate furnishings for, that make sense in your standard of living? So think about it. Okay. Another common item is, say your decedent had access to a safe deposit box, and they're missing from the decedent's gross estate without an adequate explanation. So, if you may remember, on the estate tax return, there's a question on there that says, did the decedent have access to a safe deposit box? So, if you answer yes, then you need to put on your Schedule F an explanation. Oh, it's a bunch of personal papers, marriage certificate, veterans papers, death certificates, copy, the client's original will, nothing of commercial value. You need to say it, okay? And here's a practice tip in making sure that you got everything, because the clients may not necessarily think about it. So when and it's on my checklist for initial items to bring to your estate administration intake. Ask for the decedent's homeowner's policy or renter's policy. Specifically ask for the riders, okay? And note, are there any collections of art or jewelry, okay? Do not find yourself in the position where the IRS will ask for these things, because they will as part of an audit, and they look at it and they go, oh, here's a rider, and you have, the decedent's 3-carat engagement ring, a Cartier watch, a diamond tennis bracelet, or $100,000 of jewelry and antiques, and here on Schedule F for the tangible personal property, the appraisal, it's not there. Why are you paying for a lot of money on insurance if it's not here? So, let's avoid being caught in that trap, okay? And again, if you have that access to the safe deposit box, give the explanation. This is what was here, it wasn't there. And I'll also say contained certain items of decedent's jewelry. Those items have been valued and have set forth in an appraisal to the attachment to the 706 and are listed in Schedule F. Okay. Audit issue number 6, failure to include and or value all decedent's assets, particularly hard to value assets. Now, here, one of my favorite ways to make sure I got everything is that get your decedent's prior income tax returns for the last 3 years. And it's on that initial checklist that we talked about earlier. Okay, so take a look at those income tax returns, because that way you can look at the income tax returns, look for all those different little trails of assets, and make sure they're on the schedule. If they're not on the schedule, ask why. Also, if you have unresolved litigation, you got to make sure that's on the schedule. So here's some common errors that we found in this particular category. So, 1, you got to properly record your accrued interest, stock dividends and stock splits, okay? You have the decedent's date of death and you have interest that's accrued to date of death. Stock dividends, these are dividends declared to shareholders before death, to shareholders before death but paid after death, okay? Or there's stock splits. Now, one of the practice tips here is, you use a valuation service instead of looking each one of these stocks up individually. EVP hasn't paid for this part of the commercial, my program, but I happen to use them. That's my understanding is who the IRS uses. I know a lot of the brokers will furnish that for you, but make sure you properly get those items. Okay, all right. Again, items reported on the decedent's income tax returns but are not reported on the 706. Again, cross-check them. I've done this before, and we found things that were missing. Oh, here 2 years ago I saw interest on XYZ bank account, but it's not on the last year. Or, oh, here's dividends the 2 years ago from this stock. What happened in the final year? Maybe the accountant made a mistake. The decedent forgot to give them those proper 1099s, and now we've uncovered assets. Make sure you got everything. Okay. Another item, loans. Loans to children or other family members that are not properly substantiated, meaning that they may not be true loans at all. They may not have had, the interest was not paid or recorded. So take a look at that. Now, here's a practice tip for a Schedule K unresolved debt, maybe perhaps due to litigation. So as some of you may know, there are relatively new regulations under 2053 of the Internal Revenue Code where the taxpayer only gets a deduction for the actual amount paid of the debt. So what happens here, because you only get the deduction for the actual amount paid, but you haven't paid anything because it's not resolved, so what the tax practitioner is going to do here is they're going to file a protective claim for a refund. They'll pay the tax because you don't get the deduction. You'll file that protective claim for a refund. Now, there's no statute of limitations for claims So the IRS, in processing your request to get your money back, is at the bottom of the pile. Now, an estate tax attorney, if you're an estate tax attorney for the service, you can be wrong on positions, but if you can't blow a statute. If you blow a statute of limitations, you're going to get fired. But the IRS is not going to be following up with you on resolving your claim. So you have your protective claim for a refund. They're not going to be knocking on your door, hey, have you figured it out yet? Do I owe you any money? They're not going to be doing that. The onus is on you. So as soon as that claim gets resolved, you have to follow up with them to get your money back, get the client's money back. You do not want to be, forgetting about this, and you do not want to find yourself in a position with the service saying they're giving you a hard time because you waited really a long time before after you knew the claim was resolved to try to get your money back. So please stay on top of this and don't find yourself in that situation. Okay. Audit issue number 7, questionable deductions. Okay. Here, any deductions taken for questionable or unreasonable funeral expenses, administration expenses, excessive legal or accounting fees can trigger an IRS audit. Now, in the attorney fee, accounting fee area, sometimes a service will ask for bills to confirm the amounts estimated that were paid. I want to say you were actually paid this. For fiduciary commissions, the service will confirm that they were calculated correctly. A informal benchmark that I've heard is that attorneys' fees should approximately equal a fiduciary fee. In some cases, 5% or 6%, but that you're not necessarily going to find that written anywhere. And again, there's always that what I call freakonomics, meaning that sometimes you have small estates and you have a lot of problems, and the proportionate value of the fees to the size of the estate doesn't make sense. But if you're in a small estate, you're not going to have an estate tax issue anyway, but more of a client expectation issue. But it's on that particular point, as many of you know, the process in an estate administration is the process, and sometimes that process does not change at all, whether that estate is $100,000 or $800,000. So let's move on to a specific issue here on questionable deductions. This is a bee in the services bonnet, where if you take a deduction for your fiduciary meals, your gas, when you're on fiduciary, tasks and supplies, and that fiduciary is taking a full commission, it is the services position that those costs are part of your commission, that you cannot take a deduction for those meals, those gas and supplies necessarily if you're also taking a full commission. And one estate tax attorney said, hey, if you're working through lunch, would you charge your client for the meal? It's an interesting point. On the other hand, and I do see this, say you have an estate tax return and you have, the fiduciaries are close family members, or they've decided not to take that fiduciary commission, then definitely take that. And then you can kind of put down no commissions being taken. So don't forget that also. Now, funeral expenses, okay? And it seems kind of a little unfair, but it is what it is. The funeral expenses should match the person's lifestyle. So in other words, if you're rich, you can have a nice big funeral. If you're not, then you got to have an appropriate match. And another point is, and this actually comes up a lot, the estate cannot fly guests in to attend the funeral, okay? So even if the adult children come in, you cannot reimburse the estate for their airfare or their travel expenses. Now, that's different for the executor. If the executor is going to go to the funeral, they're in charge of making sure it's paid. We can deduct those expenses for the executor, who is very often a family member, but not the family members other than the executor. And again, that's a common question. Okay. Another issue is sale of art where it's been specifically bequeathed. Okay, one estate tax attorney reported that if the decedent had a specific bequest of art and it's sold, the estate cannot take the sales expense as a deduction. Okay? So a specifically bequeathed item is the beneficiary's item. So if it's sold, those expenses are theirs. Okay? So that's something to kind of to think about. Okay? Audit issue number 8. Okay? Owning interest in closely held businesses like a family limited partnership, a limited liability company. So in general, owning an interest in a closely held business, a family limited partnership, a limited liability company, or just an unincorporated business, definitely proves problematic, since these assets that we've spoken about before do not have a readily ascertainable market value, meaning unlike a bank account, I know what the date of death value is, I just see it on the statement. Okay? The valuation of the decedent's closely held business is sometimes problematic because if it's not substantiated with adequate financial data, including profit and loss statements, balance sheets, statements of net earnings, and operating results. Those, if you're going to have we're going to have our business appraiser, and that business appraiser, as part of their due diligence, should be asking for those materials. Okay. In general, having these interests in closely held businesses can significantly increase your risk of audit, again, because these values are subject to interpretation. And so sometimes you just can't avoid an audit here. But as we've talked about earlier, if you hire a good appraiser and they do a great appraisal and you work collaboratively with them to make sure that this appraisal is as solid and as robust as it can be, and you understand it, you're doing the best you can under the circumstances. Prepare for and anticipate those questions on valuation and those issues that you think that could come up, and be ready for them. Okay. One way to think about is, put yourself in the estate tax attorney's shoes. Okay. And look at it through that lens. Would you sell that interest at that price? Again, that's what another estate tax attorney asks. When you read it, when you look at the value, does this make sense? Okay. Audit issue number 9. Okay. Failure to include supporting documentation. This is an easy one, guys. This one, sometimes you can't control things like you have a closely held business interest, and that's going to be that increases your risk. But if you don't include supporting documentation that's required to be included or should be included, that bad's on you. So let's talk about that. Now, first, there is a checklist for completing Form 706 on the back of the instructions, okay? And it lists certain documents, where relevant, that are required to be submitted with the 706. So, and if you fail to include those documents, it's a common error, and it was reported by many estate tax attorneys, that this is a problem, okay? So some common examples here, and I mentioned earlier, you failed to give all the decedent's lifetime gift tax returns. That's your Form 709. You forgot to include a copy of a death certificate. Now let me just stop here, because you don't need to give an original death certificate. You just need a photocopy. And if you remember, the original death certificate has the raised seal. You don't need that. You just need a photocopy. Save those, because they're generally $15 each, and you never know when you may need them in the future. Okay, it's always good to have those originals. But the IRS doesn't need an original, just a photocopy. Okay, Form 712. And if I had an audience, I'd say, what's Form 712? But I don't, so I'll just have to tell you. Form 712 is for the life insurance statement, and those are listed on Schedule D. Okay, so you got to make sure you order those in advance. Okay, so you have them ready. Copies of trust documents where the decedent was a grantor, which means they established a trust, or they're a beneficiary. Okay. Now, here's a list of other documents that you may wish to submit, but they're not required, but it could be helpful to reduce your risk of audit. Okay, 1, copies of the beneficiary form showing that the assets passed to a surviving spouse, and then it qualifies for marital deduction. Documentation showing that the charities listed on the estate tax return where the gift went to it, meets your charitable deduction requirement of Section 2055A. So you can see that it's a qualified charity. Okay. Like I mentioned before, if you're selling the real estate to a disinterested party, and that is our value, okay, you're going to give us the contract of sale and a statement saying it was sold to an unrelated party with the use of brokers if that's the case. Okay. Audit issue number 9, claiming deductions for sale of an eligible real estate. Okay. Now, this is a common error. No deductions are met, can be claimed for the sale of real estate that is specifically given, devised, or passing to residuary beneficiaries under your will or trust agreement. Okay. When that sale is not pursuant to direction to sell in that governing instrument, or that sale is not required to raise funds to effect the distribution of the estate assets, pay debts, taxes, and expenses, or to preserve and maintain the estate's assets. So here's like a little practice tip, which we'll talk a little bit about later. And that's something I always ask in my estate planning phase. When I'm doing the intake on what you want for the will or trust, ask them, do we want a direction to sell the decedent's real estate on death, if there's no spouse. So that way, we'll have that ability to take that deduction for all that sales cost. And that could be real, there could be a meaningful amount. You have your real estate, you have your broker's commissions, you have your lawyer's fees, maybe you have real estate transfer taxes, because that could add up, especially for a very large property. And very often your estates have two big pieces to it. The two big assets are your real estate and your retirement accounts. Okay. Number 11, a real easy one to fix, folks. Have an unprofessional appearance. I remember one estate tax attorney joked to me, hey, you're showing up on an interview, and what are you going to do? How do you think I'm going to think about you if you show up with your sneakers on, as opposed to having a nice pair of well-polished shoes? Okay, appearance does count. Listen to your mother. They do say, books, you shouldn't judge a book by its cover, but people do. So a return that gives a professional appearance, gives a positive first impression to the service. You want it to convey the message that the substance of the return, like its appearance, was carefully and meticulously prepared. On the other hand, if you have a return that's handwritten, sloppy, unbound, or is less than a finished appearance, like the pages are bent, and you spilled some coffee on a little part of it, and you wiped it off, it's an invitation for the service to have a closer look. So practice tip for you here, folks, is that make sure your return is clean, neat. Make sure the print is dark. That when you printed it out, your toner wasn't low. Make sure the return's references to the proper attachment are correct, meaning here's an example of attachments that I have, and they're all tabbed and numbered. I showed you earlier about the index. So in the return, it's going to say for example, we have on Schedule A, sale of decedent's home. I'll say, here's the value of the home. Say it's $1 million. Sale of decedent's home to an unrelated party. Value based on contract of sale. See item 1 in the attachments. Make sure all of those references match your attachments. Okay. If you're including statements like to show your date of death value or alternate value, or your Form 712, make sure those copies are straight and are clean. If sometimes have those statements, they have those extra pages or a blank page in between. Go through them. Don't include a page that doesn't really add value. It doesn't make sense. Take it out. Look through everything. Okay. Audit issue number 12. And I love this one. Common proofreading errors. A common sense item that you can do and reduce your risk of audit in a meaningful way. So the service reports that proofreading errors are very, very common. The number one mistake, and if someone was here, I would say, remember this one for your 6 items. The number one mistake here is the transposing of the digits of the decedent's Social Security number. Okay, so that's another one of the 3 things I want you to remember in 6 months' time. When you're going through your estate tax return, make sure you have your death certificate. Make sure you have your estate tax return, and make sure you get that Social Security number right, date of death right. Make sure you have those basic things correct. Okay, and it can be especially problematic when you have your 706 and the payment of estate tax list different Social Security numbers. due to a transposition error. So you have a payment not being credited to your account. We don't want to have that. That creates additional time and delay. You can be fighting penalties or interest. Make sure that's right, please. Okay. Common math errors that were reported are the state death tax deduction's wrong, the adjusted taxable gifts is wrong, and the credit for tax for prior transfers is wrong. Know those are items that are commonly made errors in, and take another look. Okay, and this may be a sales point for using buying that estate tax return program. But one estate tax attorney reported to me that math errors are the most common when that estate tax return is prepared by hand. The old-fashioned way with the calculator and the tape. And she said instead of using a program, and that she still sees large estates done by hand. Try not to fall into that trap. If you are going to do it by hand and you don't want to, buy the program, double check, triple check those numbers, and think about it may be worth it. That extra time that you're done confirming everything, you could have spent that same money and bought the program, and given you that a little bit of extra insurance. Okay. So let me end with this part of the program on some recent final tips. Recent, this is from some recent conversations that I've had with some folks in the service. One, any estate over $9 million is now automatically selected for audit, so be prepared, okay? Now, in this case, the inquiry may be limited, or may you never know that was looked at, but it was carefully reviewed, okay? Another one, which I think is a good one, loose lips sink ships. Now, here, some IRS state tax attorneys told me some of the best results from the IRS are from the clients, okay, where they rat each other out. They'll be like, hey, you're looking at this on the return. Well, what about that dad? What about the house that dad gave you like 10 years ago? And what about, the diamond necklace and all of that jewelry or that art that you gave sister, 7 years ago? Don't do that. So the tip here is keep your clients out of the audit meetings. Do not bring the executor, okay? It may be, they take it way too personally. An audit will not be bad if you have nothing to hide. Work with the estate tax attorney to close the estate. Give the documents when they ask. Be cooperative. The IRS is not necessarily out to get the client, and people get no one wants to pay anymore. Okay. Another point here is that there is a big penalty risk where there is a gift to the executor, and the executor forgets to list that on the estate tax return. Not good. Okay. Again, I just want to highlight that my article is part of the handouts. It's an oldie but a goodie from the Estate Planning Magazine. It's going to review some of these points in depth, and also include a few more that we didn't cover today. So let's now move on to another part of our program where we have about 20 minutes left to talk about best practices for the preparation of an estate tax return. So the first one I have is like the old Girl Scout or good Boy Scout motto is plan early, okay? Manage the client's expectations of the estate administration process and the filing of the estate tax return. Like, talk about the timing, who the responsible party for getting the information, and the delivery dates, okay? So now, to that effect, remember I had that checklist, okay? It had that little checklist for the refrigerator where we have, here we go, this checklist, okay? And I sit down with the clients and I say, okay, the federal estate taxes are due on this date, if any. State estate taxes are due on this date. The alternate valuation date is on this date. Submit all information for the estate tax returns by this date. Make sure it's enough time in advance. Make sure who is responsible for what, okay? I complete this, this checklist. I have it for myself, I have it for my staff, and I give it to the client. I say, this is for your refrigerator. So that way, when the paralegal in my office is working with them on the preparation of the estate tax return, remember the list on your refrigerator, remember that date. Okay. Next, okay. Identify necessary information at the initial estate administration intake meeting. So in other words, you want to identify here needed statements. You know, do we have missing gift tax returns? Do we need appraisals? You know, plan to have those tasks done on a timely basis. And that's, you know, that's where we come into play for our checklist for the meeting. We're going to be getting the checklist here, you know, the checklist, and it tells you the information that we need. You know, the social security numbers of the decedent and surviving spouse and the children, our 3 years of income tax returns, so we can try to look through and identify all of the assets, life insurance policy information, safe deposit box information, partnership agreements, copies of any trusts that were involved, copies of any deeds, give the family tree. So, you know, here's our list. You know, you have the information, you know you're going to need it. If you need an appraisal, you can identify, oh, I'm going to need 3 appraisals, get it done now. The last, you know, even when you hire the appraiser, you know it's not going to be done the next week. You don't want to be caught running out of time. Okay. Have status meetings with the client regularly and any necessary professionals, like your appraisers, like your accountants that'll be working on any gift tax returns, the final income tax returns. So you want to make sure you stay on track. Okay. Another tip: prepare a hard number for for that payment due date. That's at 9 months in advance, and then provide a draft of the estate tax return to the client to review in advance of that hard number. So I'll give them that draft. I'll say, hey guys, you know, here's a draft of the estate tax return. Take a look at it. Look at the assets. Look at the values. Is there anything in there you think that we forgot? Do these numbers look right? Take a good hard look too. Okay. And here's a practice tip when I'm making that estimated payment at 9 months. I personally like to include a cushion in that estate tax payment if possible. And that cushion, you know, I found it useful because it can cover unexpected surprises like a missing asset or maybe a reduction in anticipated expenses or debts, okay? Also, just kind of psychologically with clients, you know, after we finalize and file the estate tax return, they love hearing, oh, by the way, you know, I'm getting a $500 refund. Now, the fact that they spent thousands of dollars, you know, is sometimes diminished. Oh, a refund, $500. You know, they're happy. People, you know, psychologically, people are happy to get a refund. Instead of, oh, you know, I kind of got bad news for you. You go $1,000 extra, and they're like, oh, you know, I already paid this amount. Oh, and there's interest too. You know, it's just better to get that cushion. You know, if the client is willing to do that. Okay. Another tip: schedule a final detailed review, you know, for yourself with adequate time to address any details and changes in advance of filing. You know, have those delivery dates on your calendar, and if the estate tax return is due in a couple weeks, have that hard review, you know, with adequate time, because as you're going through it, maybe you'll catch something. It's like, oh, what about this or what about that? You'll need the time to ask the client, oh, I need information, or let's clarify this point. Okay. Another point is consider having a second pair of eyes to review the return before it is filed. I just think it's just good because, again, we're all human. None of us are perfect, and it's just natural, you know, to read something and miss something, you know, because you've been preparing and you've read it 4 or 5 times, and your eye just naturally travels over it. You know, have a second pair of eyes, take a look at it. Another point is, and many of you probably do this already, send the return certified mail return receipt requested or in some sort of secured mail service. This way you have absolute certainty when you filed, so that way the IRS can't come back and say, well, you filed it late. You'll have, you know, the written green card back that they got it. And another favorite of mine is I like to actually file the return a few days before the actual date if possible, because that way there's no question that the clerk that's putting the return in the system, doesn't, sees the date, it's like on the due date or near the, the day before the due date, or if it's on, that we reduce that risk of the IRS giving you one of those generated letters. You filed it on time, but it was, the day of, and they said it was late. It's like, no, I have to now go for my card and produce it, and, so try to do it I think it's good to have it a few days earlier. So, and then, with that, I had that sample index that you, to the estate tax return in your materials. I have that here, and, just to give you kind of an idea of what attachments look like. So, I hold this up. This is kind of like for an average estate that I've done, like maybe a little bit over $1 million back when the New York State threshold was, was a lot lower. And here we have the death certificate, a certified copy of the will, copy of letters testamentary, approval of extensions to file and or pay. I'm including the estate tax powers of attorney, 3 years of income tax returns, statements on the valuation of the securities through the valuation program, copies of certain securities I hear showing that certain securities were worthless, and you have your appraisals. Again, it's on your sample here, okay? And then last is your computation of residuary estate. Here, this big, huge one, I actually switched recently from having it bound to having it with a clip on top. Now, this is an estate that's much larger. The reason why it's, like I said, it's like a big Manhattan phone book. Here we had, several trusts that decedents did during their lifetime, and their income tax returns were also very large. So, that's, give you an idea here, okay? So also here, we're going to, so that's your sample for your estate tax return attachments, okay? We have a little bit, about 15 minutes left, so we'll now go over reducing the risk of audit in the estate planning phase. So here, we're going to want to make sure we obtain, in the estate planning phase, if we can, let's get copies of the gift tax returns for the client for their lifetime and review them for any possible issues of lack of adequate disclosure. Also, if you are going to be, doing some estate planning, because this is the estate planning phase, you need to know how much exemption is left if you want to try to use some of that exemption. So you're going to need it for that anyway, okay? Identify and discuss any convenience accounts and joint accounts and have them documented during life. We said that earlier. A practice point here is that instead of making a convenience account, maybe give that trusted person power of attorney instead of having their name on the account, okay? Because if it's a power of attorney, the power of attorney dies when the person dies, and their name is not on it, so we don't have that issue of it appearing on Schedule E2 and having an explanation. Let's discuss and review any valuable items of tangible personal property, like art, jewelry, and consider gifting strategies during your life on that. So many times, for example, tangible personal property, the fair market value of it is a lot less than if you purchased it. Like, for example, jewelry. I remember in one of my many jobs that I had, before I, got my final job now, when I was a young person in school, I used to work for a jewelry store, and I remember we used to have a markup of 3 times. So the wholesaler would come in, they'd give it for this price, we'd mark it up 3 times and sell, and that was industry standard. And the wholesaler is buying it from the person that's manufacturing, so there's a markup there. So your fair market value of what maybe, if you were selling that jewelry, to a wholesaler or for liquidation is going to be much less. So they could be, good items to give away. And also, if those items are less than the annual exclusion amount, you may not even have to file a gift tax return. Okay. Also, discuss and consider valuation issues and gifting strategies for closely held business interests. So you have a closely held business interest, it's going to increase your risk of audit, but say your decedent had a controlling interest, okay? Now, if your decedent has a controlling interest, there's going to be a premium for that controlling interest in the appraisal. Maybe consider gifting that controlling interest and turning it into a minority interest, okay? Again, for the gift, you're going to need an appraisal, but, that might be a good thing to do during the lifetime. Think about it. Okay. Now, this is more of like, again, of a general suggestion in the estate planning phase is that think about when you're doing your estate plan, reducing the risk of family controversy and probate issues by careful planning. In that there's value added here in reducing the risk of excessive legal fees that could cause issues with the IRS. So, they're going to look at the estate tax return. There's going to be estimated estate, attorney's fees or actual paid, but you're probably going to have an estimate. That's a lot of people do that, especially if there's litigation or some controversy. And I should just say this: you don't have to have an actual, a proceeding filed in order to have big legal fees because of people not getting along with each other. It's a lot more when there's obviously a proceeding file, but I've seen many situations where people aren't getting along, and it just creates, a big ripple effect, and increase of fees. So think about when you're planning to reduce family controversy or probate issues. So here's an example. So, there's a very common one: the use of a living trust to avoid probate if it's appropriate. Okay. Remember, one size plan does not fit all. Take the time for your client to make sure, take a look at the assets and the family, and because each family and asset situation is unique, and see if, and think about if that strategy would make sense. Make sure the assets of your plan coordinate with the plan. So you have your plan and you have your assets, and make sure they fit with each other. In other words, don't draft a will like you're taking an order in a restaurant, like, oh, I want this, I want this, I want this, without thinking about how is this actually going to work in the estate administration process, in the family, what's going to happen, okay? Some common examples here, and this is something that just came across my desk recently, where, the will was written and they didn't coordinate the assets and they just kind of took like an order in a restaurant, and we have the will giving away more property that was in the probate estate. Okay, so that now you have an abatement issue. Now you have a whole bunch of paperwork that's required for an explanation and to deal with it. If you had, in the estate planning phase said, oh, client, you want to give away $100,000 to this charity, and you want to give these small gifts to that person, and you have everything jointly held, with your adult children, with your wife, and then you only have, an account of $20,000 that has to be probated. I mean, you got to really think about it. Okay. Ask about commissions to family members. That's a hot issue. Consider, how the will presents itself. Does it seem fair? So, in this particular situation, I've had situations where a family would say, we have 3 children, but this one child, the 2 of them are doing very, very well, but this one child is working, in a job that's public service and isn't making much, and they've got 3 children of their own, and the other 2 are just doing so well. We want to do a little extra for them. Now, a lot of times it's understandable why you would treat people unequally in that situation, but still, people have a hard time getting off the equality. When you're a child. So an idea where it presents fair, but you still take care of that child is like, we have a will that gives everything in 3 ways, but maybe we have, a life insurance policy just benefiting that child, so it passes outside the will. Maybe you have a joint, a payable on death account. So again, it presents fair, but maybe you take care of that child. You want to give a little extra, and then you'll have an explanation why. Okay. You want to update your beneficiary designations of your life insurance and retirement plans to make sure it's consistent with the plan. Okay. Let's end on, we have about 6 minutes left. Let's talk a little about working effectively with the IRS during an estate tax audit. So you listen to this course, you've always been careful, you did everything you can, and your number still comes up. Maybe because the estate's very large. Maybe because there's hard to value assets like closely held business, or you have it's a large art collection. You've gotten your notice of audit. So, first of all, and again, these are my personal opinion, not necessarily going to find it in a book, and everybody, approaches this differently, but this is what's worked for me. I'm always professional, courteous, and respectful to the estate tax attorney. It's not personal. It's a job for them, just like this is a job for you. And also, I think it's good for me to handle all the estate tax attorney. You as a tax practitioner, you handle all the communications with the IRS on behalf of the client. As we talked about before, loose lips sink ships. Do not have the client present or have conversations with the IRS. They could really be their own worst enemy, and they could say something that's damaging and that may not even realize it. Also, you get that letter. Sometimes you get a phone call first, but if it's a letter first, I like to reach out to the estate tax attorney promptly upon notice of the audit, and I like to try to establish a positive relationship to work together, that I'm friendly, I want to address this in a collaborative manner, and I'm going to try to ask them the big issues, the why. Why was this selected for audit? What are you looking at? What can I do to address your questions in an efficient manner so you can get this case off of your desk? Clarify what exactly is needed. And then see if you can find out from them, the estate tax attorney from the IRS, what exactly you're looking for to favorably address this issue. And then confirm with them what exact information is needed and in what form, okay? Usually, a lot of times you'll get this letter of audit and it's like this huge laundry list, but I would, some of those things you may know from your return doesn't really apply. So in that initial conversation, talk about that and really drill down to what exactly is needed. And again, trying to find out the why. Why was this selected for audit? What are your big concerns here? What can I do to address your concerns properly? Another point is, and if you can, depending on where the estate tax attorney is located, and this is my personal preference, consider having an in-person meeting soon at the beginning of the audit to try to build a positive relationship and address any initial concerns. When they come to your office, be a gracious host to the IRS estate tax attorney. I have little snacks, water. In any controversy, this is just kind of like basic human relations. If you're nice and polite and courteous to somebody else, and if you even manage to get them to like you or develop a mutual feeling of respect, if you have a controversy and you build that strong relationship and that more friendly relationship, they're going to be more willing to work with you. And in the area that there's that there is kind of a close call, they'll give you the benefit of the doubt, hopefully. Okay. Also, you'll be working in this audit, and you're going to give them information. You have some of it over. You're ready to go with some of it. Maybe talk to them in advance. Let's clarify and confirm what I'm giving over to you, and making sure I'm getting you exactly what I need. Again, what I'm looking here for, the more positive communication builds a positive momentum and a better relationship for a beneficial outcome, for your client. That's the name of the game. In conclusion here, when it comes to the preparation of an estate tax return, recognizing those issues in advance in the preparation and filing of the estate tax return, recognizing those issues that are most problematic for the service allows you as a tax practitioner to take preventive measures to reduce the risk of audit for selection. Now, many of these areas we talked about can be addressed by common sense, but are nonetheless are still prevalent in the field because they have been reported to me by multiple estate tax attorneys to the service. Take that additional time and give careful attention to the details in your estate tax return even if you think, oh, I've read it through twice already, put it down, take another look at it. Have somebody, a second person, be another set of eyes. Also, during an audit, take the effort to build an effective working relationship and identify what exact needs the estate tax attorney is looking for and how to address them. And that'll yield benefits to the client. And last, in the estate planning phase, take a look at those issues that could potentially come back and bite you. And, I just end on, sometimes these little minor errors and oversights can cause a disproportionately adverse result. So be proactive here. I have a question here from a viewer. I'm glad someone out there is actually watching. No. You said a $9 million estate will be audited. What's the smallest you've ever seen? I will tell you, the smallest that I've ever seen was, a bunch of years ago, and that was where my estate was selected because they were training a new estate tax attorney, and that was kind of a bummer. The good news is that that particular case resulted in a refund to the client, and the reason why is, maybe by people out there I would ask, but I don't, so I'll just tell you. The reason is, the cost of dealing with the audit, it's additional legal fees, which are an additional deduction, and if there's no change, that additional deduction will reduce that tax, which will create a refund. But it can be smaller. It doesn't necessarily have to be $9 million. If you have any of those controversial issues, you could be selected. So it looks like my time is up. I would like to just take 5 seconds out there for you in computer land. If there are any questions, throw them out now, because they're going to be throwing me out. Any more? Okay, well, it is now a little bit after 12. I hope everybody learned their 3 things in 6 months' time. Thank you for watching, and have a great lunch. Thank you.